as Dale mentioned, I don't think anyone ever refers to the tax man as Santa Claus, but there is one tiny little tidbit you'll see in my presentation that the tax rates are going down in New Brunswick. So everybody can put a little cheer up for that. So what I've set it up as basically are 4 main kind of areas. So we're talking about saving taxes when you set up your business, taking money out of your business while you're running it, some tax effective ways of doing that, selling your business, how do you do that in a tax effective manner? Again, just some points, not a recipe card or anything like that, and then just a few little bullet points as far as tax planning ideas. In terms of setting up your business, there's one particular point that I felt was really relevant in terms of setting up your business and saving taxes, is the New Brunswick Small Business Investor Tax Credit. That is a 30% credit on eligible investments. But the advantage of that tax credit is that it will offset personal New Brunswick taxes for the year you make the investment, as well as the previous 3 years if you can't use it in the current year, or you can carry it forward for 7 years. We'll move along here to taking money out when you own your business. The tax rates now, fortunately in New Brunswick, are very advantageous in that this particular question isn't necessarily a be-all end-all. If you don't do it right, you're doing something wrong. There is no real hard and fast answer anymore. There used to be. It used to be that if you did not earn, if you earned income above the small business limit in New Brunswick, and you didn't quote-unquote bonus it down to the small business limit, the rate of tax you were paying on that excess income was so high that when you eventually took the money out, you could be paying somewhere in the neighborhood of 60% tax in total. Now that's not the case. So, tax-free amounts. This is the fun one. We can get tax-free amounts out of our companies in certain circumstances, and these are often overlooked. The next thing, deferring tax on sale of your business. So say you've sold your business and you're in business number 2 or 3 and you don't have an exemption available to you, and now you want to sell this business. So you don't have the number one go-to solution is your capital gains exemption. You don't have that available to you anymore. There is an opportunity to defer tax by using a holding company, setting it up properly and extracting some value out of your company before you sell it. There's pretty complicated rules there that you have to follow, but it's very common. And it is something that should be considered anytime you're selling a business and you don't have full capital gains exemption available to you. And basically what it is a deferral of tax until such time as the funds are withdrawn from your holding company. So there is an opportunity there to defer tax, but if you want the cash in your back pocket, you will eventually have to pay tax on it. Selling assets, there are certain strategies that have been blessed in the courts. Revenue Canada doesn't like them, but the court does apparently. Whereas a sale of assets can be structured such that the capital gains exemption can be used at the same time. It requires a willing buyer, because the buyer has to say, yes, I'm okay with what you're doing before we go ahead and do this transaction. So that is available, something to consider. If that doesn't work for whatever reason, and the buyer really, really wants to buy, or yes, to buy assets, instead of it being a sticking point, or perhaps you don't have an exemption available anyway, one of the things that really should be considered is the allocation of proceeds in terms of the assets. So if you can allocate more proceeds to goodwill, intangibles, intellectual property, those types of things, customer list, those types of things, that is taxed at half the rate that would normally apply to any other type of asset. So that is something in particular with high-tech companies and IT companies and growth companies with a lot of intellectual property, that is something that is really quite legitimate, that a lot of the value would be allocated to that. But if you don't think to allocate it in your agreement, then you may have lost an opportunity there. Small business corporation rollovers, this is a federal rule. This is particularly complex, and we haven't found a lot of situations where it applies because it has to be an eligible company being sold and an eligible company being purchased. It has to be done within a certain period of time, which is 120 days from the end of the year that you sell your first business. But it is effective in that it will defer the gain on the sale of the first business until such time as you sell the second business. So some quick other tips here so we can wrap up. And I'm sure you've probably all heard of these. They're not particularly proprietary. TFSA, tax-free savings account, $5,000 a year for everybody who's over age of 18. Money going in is not tax deductible like an RSP is, but the money in there grows tax-free and it can come out tax-free. Loss selling. Basically what this means is you sell investments that you have at a loss now because the markets are down from where you may have bought them. Say you bought them in 2007 before things went south, You could very well have a loss, so you could sell them at a loss, there's certain rules about acquiring it back again within a certain period of time, but sell them at a loss and then carry that loss back to obtain taxes you paid in a prior year. Our RSPs, 18% of your earned income, which is basically your employment income and your business income, you can put in an RSP, get a tax deduction for it, grows tax-free. Our ESPs are registered education savings plan. They're sheltered in terms of income. They're not tax deductible when you put the money in, but the income is sheltered and it's taxed in your child's hands when it comes out. So that's an opportunity to, that income splitting that I keep talking about. And if you know anyone who's older and who's receiving a pension can be split amongst spouses now. So that's an opportunity to income split. We have a lot of pensioners whose female spouse did not work throughout their lifetime, so they don't have a lot of income, they don't have a lot of pension. And pension income splitting is a significant opportunity. They put that in a couple of years ago. A lot of people aren't aware you can split your CPP as well, but you actually have to split it, like, apply for it at HRDC and the money will come half and half to each spouse, but there's definitely an opportunity there to save some taxes in that regard. And then finally, the R&D credit. I couldn't do a tax presentation without talking about an R&D credit. Lots and lots of money. I put a whole bunch of dollar signs at the top of my slide here. Lots of money. Feds, province, there's lots of credits available. 35% federal credits in some cases, 15% provincial credit in all cases. Provinces credit, and this is New Brunswick, the provincial credit is 100% refundable. So if you're a high-tech company, if you're developing intellectual property, if you're a manufacturing company that's developing new products and processes, that's cash in your pocket. And that's good because you need cash a lot of times. And I put a little example there. Well, first, file early. Don't wait until the 18-month deadline. You have 18 months from your year end of your corporation to file an R&D claim, and if you don't, it's gone. So don't wait 18 months. Don't go beyond 18 months because it's gone. And do it early. If you do it with your regular tax return, oftentimes it'll get processed the same time as your regular tax return gets processed. If you don't, it could take months, sometimes years to get processed, depending on how big it is. But one example here, if you have $100 of R&D wages, eligible R&D wages, it could only cost the company $25 after the credits are considered. So what that means is the feds are giving you $75 for every $100 of eligible R&D wages. So that's pretty significant. There's not a whole lot of other benefits out there in the tax world that are like that. So that's something to think about.